Welcome everybody. My name is Stefan Friedrichowski, and today is the next webinar of developing superb trading strategies in cooperation with Argus FX, the broker of our choice. I hope you have a nice weekend up to now, and trading went well for you. It's not difficult. It's quite difficult right now, not easy, so to say. But we don't want to talk about trading specifically like a weekly forecast or something else. No, we want to go further into trading strategies. And the topics for today of the 11th of August 2016, that's only for the records. It's similar as every week because we want to do our work all around trading strategies, and there's no real start, there's no real end. It's an ongoing issue. It's always to make one step further and to learn. Simply to learn about developing trading strategies. Today is a big, call it final for our first Dax strategy developed during that webinar series here. It's the final one. So next week we change our topics, and you can be curious what comes next, and it will be around so-called class trading, a new approach, but that's for next week. For today, there have not been that much questions last week. There's only one remark I want to make. Then let's go into the other details, and that is especially a little bit more details about my personal optimization key figures. So those key figures I want to optimize in order to get a robust and stable strategy. And that has to do with the neighborhood analysis. I mentioned the topic already earlier, but today I want to show you some more details on what I do there, and what is the purpose, and what we can achieve with that kind of methodology. And final step, of course, last things to do, that we have our DAX strategy ready for trading. Please note always the risk disclaimer here on the lower end of my slide. Everybody knows it, and knows that all your trades are on your own risk. I have to mention that always. So a little bit, I have to apologize for that, but that's an important message to be done. So let's step into our topics of today. So question and answers, there was quite a lot of feedback all around the Excel sheets. Lots of people have been interested in getting those Excel sheets for the DAX strategy, so I have sent it around, and many thanks, because that kind of interest confirms me that I'm doing the right job here for you, and that is always welcome. Okay, so that's all around the questions of last week. By the way, questions, whenever you have a question, do not hesitate. Just use the chat functionality of your control panel, and you can ask me online here questions, and I try to answer those as soon as possible. And if it's a more general question, then I will postpone it to the end of the webinar. Otherwise, I do it online during my talk here. So I mentioned that I want to show you once again a little bit more about my personal key figures all around trading strategies, and that's really that must be a very short list, because if you want to optimize a trading strategy, that can't be a very complicated list of things you want to optimize. Finally, you need one one key figure, and that should go to a maximum or minimum. Depends a little bit on the definition, what you want to achieve. So whenever you do optimization, that's a really general statement, you need one final figure. If you have more than one, then you need a formula how to combine them and to find a finally good result. That only means you transfer your former several key figures into one again. Same approach I do here, a little bit more or less, but it's only in total 3 numbers I take into account whenever I talk about trading strategies. The first one is quite easy. That is a profit per day, or so to speak, the slope of the equity curve. Since I do all my strategies by calculating every trade in the so-called value R, that is only a number, so a minus trade finally, which goes into a stop loss, has a close value of -1, so that is exactly the value you lose per trade. Of course, if you have a stop loss, and all my strategies have stop losses, and by the way, otherwise you could not do it in the number R. What I do is I calculate the slope of my equity curve, and if your x-axis is in this case days, then the slope is simply the number profit per day. So of course this number should be high, so that we have a good increase in our equity curve. So that's the first key figure. The second key figure is within the equity curve you have always a maximum drawdown. So the maximum drawdown is defined as the deepest step to the south from a local maximum, and does not mean that you look for trades in minus, so that you have maybe 10 trades in a row and going into stop loss, and if that repeats 10 times, that means you have a -10R loss. No, the maximum drawdown is a little bit different. Think about a strategy which unfortunately makes 2 steps to the south, 1 step to the north, so -1, -1, +1, -1, -1, +1, and so on and so on. So that goes to the south, and further. So also that has to be taken into account. So it's the maximum drawdown is simply defined from a local maximum to the next minimum, and whenever you have within your equity curve the longest path down to the south, that is called the maximum drawdown. That is a very important number, because you would feel that number in your account, seeing that it goes south, for example, and therefore it's quite easy. The maximum drawdown in the unit R should be low. So we have one number which should be high, another number which should be low. Therefore, it's quite easy to say what comes next, and that is a number I call in all my strategies the so-called profit factor. That is a little bit misleading, because therefore it's in brackets here. Profit factor seems to be a number which should be high, but in my definition, which I have done now, I think 6 years ago, I did it the way that I calculate maximum, so the quotient maximum drawdown divided by profit per day. So I have in the numerator the maximum drawdown, and in the denominator the profit per day. What does it mean? This number should be low. So that is the number which should reach a minimum. And there's one other number I take into account. That's a little bit because everybody likes linear equity curves, and the linearity of a graph can be calculated quite simple. That is a well-defined number between 0 and 1. 0 would mean it's more or less random, and number 1 means you have a perfect straight line. So since everybody, and I too, likes linear equity curves, so the final number which goes into the equation is this R square. This R has nothing to do with the risk R. It's just the definition of that number. And so the final number I always optimize is which I call personally opti. That is always a variable in my C code. This is always called opti. And finally, that number is something calculated maximum drawdown divided by profit per day divided by R square. So R square is once again in the denominator because it should be 1 and not 0 or close to 1, and therefore we want to have that final number, this opti, being a minimum, and then we call that strategy a good strategy. That is really my final number I always consider for optimizing strategies. It's quite simple to calculate, and I can cross-check one strategy to another one simply by looking exactly to that number. All of you which are a little bit more familiar with mathematical considerations would realize that there's one open question within that formula, and the one open question is the length, the duration of the equity curve or the history you have considered, because the maximum drawdown in general, the longer you run a strategy, the higher the maximum drawdown will be. That is simply statistics. So what you have finally to take into account is that you have either to look to the same history, the same number of days or years, or you have to recalculate that maximum drawdown with respect to time, and then you can simply use a square root behavior for the time dependence of that number. That sounds a little bit complicated right now, but I only want to mention that for completeness. One remark here, because that is astonishing a little bit, and it was not in my intention to have exactly that kind of number being that meaningful, but this so-called profit factor has a real meaning for your strategy. And it needs some time that you realize exactly the meaning of that number. That number, for example, is 1,200 for a strategy. So what does it tell you? This 1,200 being the profit factor for a given strategy. If you look to the quotient here, maximum drawdown divided by profit per day, that is a number without any unit, because the maximum drawdown has a unit R, and the profit per day has a unit R, by the way, per day. If you would do both in euros, once again, it would cancel out. Finally, that means that if you have, for example, a profit factor of 1,200, it means that if you want to earn €1 per day with that strategy, then you need an account of €1,200 to run that strategy. This is only mathematically correct. With respect to brokers and margin requirements, that is not correct. But let's keep a little bit to the pure math here. Why is it that you need an account of 1,200 to earn €1 per day? That is exactly the definition of that quotient here. When you run that kind of strategy, you would earn that €1 per day, but once in a time, you would encounter a loss of €1,200 because that is the maximum drawdown, at least with respect to the history. So it's a really good number, and I know it took me really hours to think about it and finally realize the importance of that number. So it's a quite nice number because it has a real meaning, better than any other number. Of course, you might think about other key figures of strategies like, for example, Sharpe ratios and so on. You can apply those as well, but I want to have it extremely simple and with really some numbers which I have always look for when I go to my account and look for my strategy. Of course, I ask myself, what is the profit per day? And I ask myself, what is my drawdown I would suffer? So those numbers, make sense and are important for trading at all. So that is one remark. My key figures for optimization, any strategy. So final answer, take that opti and try to find a minimum. Then I know I have a good strategy, and just try to find a minimum for that number. I will show you for the Dax strategy later. So that's one remark, how I optimize strategies. And the other remark is concerning this so-called neighborhood analysis in the parameter space. I know that always sounds a little bit complicated, but there's no way to describe it other. Because just think about a strategy like our Dax strategy. We have, for example, 3 values we can change. We can change that EMA period. We can change the percentage value for our stop loss. And finally, we would have something like the risk reward ratio for that trade. And we have those 3 parameters, or those 3 degrees of freedom. That span the parameter space for our strategy. And of course, the optimization process then is looking for those values which give us a minimum for our previous defined opti. But now we want to be sure. Sure does not guarantee you anything for the future, but at least we want to avoid over-optimization, or so-called curve fitting. Those might occur when you have the capability of really looking very close to your parameter space. And what you might realize, we have a perfect result with an EMA value of 209, and your strategy simply drops in profitability when you change the 209 EMA period to 208. And if you would realize something like that, then you should be careful. To keep or to have a more mathematical definition of what I simply describe in words by that dramatical change of your result between EMA period 209 and EMA period 208. Let's have a look to an Excel sheet, and then you can realize what I do when I make that neighborhood analysis. That's quite simple. Let's first only look to the first row here. What I have done here is, let's call it a one-dimensional parameter space. In this case, the parameter is simply only a number, 1, 2, 3, 4, 5, 6, and so on and so on. You might think about an EMA value or whatever other parameter you have within your strategy. And in the next line, I put some numbers just out of my head, by the way, that has nothing to do with a real strategy. And I put numbers like my opti value, that key figure opti, you know, the lower the better. And for example, we would have that kind of behavior for our value opti as a function of our parameter. In this case, just the number 1, 2, 3, and so on and so on. And we would have that kind of result. Obviously, we have the best strategy here. That is the parameter being 14. That is absolutely the best strategy. We have other good strategies around here. And already with your blank eye, I think everybody knows or has a right idea what values for your parameter you should apply within your strategy. And it will not be the 14, because that is what I sometimes simply call a singularity. That is not mathematically correct. It's only just a symbol saying for, yeah, okay, there is one value where I have extremely good value for my opti, so the best strategy within that parameter space. But obviously that area here around 30 would be much better. And what I simply do now is an iterative process. I show it you here just by numbers. When I'm on one edge of my parameter space, I can only, that's a so-called iteration step now here. The first step is the pure result of having that values for opti for the different parameters. In a second iteration step, or maybe I should label them 0, 1, and so on and so on. But in the first step here, I simply take the average of those two numbers, so adjacent values. If you look to the next cell, you see I take the average of those 3 values. And then I take once again the average of the value itself, so where I am at 3, so the 50,000, and the 2 other numbers to the right and to the left. And that goes on for the complete parameter space. And then I do that step iteratively once again, once again, once again. And what does it mean? Let's look to the graph, because I've made the graph out of that as well. And now within that graph, let's first focus our eye to the blue line. The blue line is simply the line which we have looked first. That is the real value of the opti as a function of our parameter. And now you see what happens with those iteration steps. Especially when we do the first iteration steps, the second, and so on, we go upwards around the 14, the parameter 14. On the other hand, in the area of the parameter being 30, there's not that big change for the average value, even if we do 10 iteration steps. So that means we took something, or we take something like the average of the parameters which are close to the one we want to investigate. And finally, what we do for choosing the right parameter for our strategy is looking for the absolutely minimum, for example, in this case, after 10 iteration steps. So the value of choice would be then 31, exactly where my mouse cursor is right now, because after 10 iteration steps, in this case, I find a minimum, and that minimum is here. So what does it mean? That number incorporates all the neighbors to some certain extent. A neighbor which is very far away in the final result has not that weight like the central values. That is simply because of the kind of iteration steps. But even neighbors of a distance of 10 are already within that number. Distance 10 because I did 10 iteration steps. So finally, if I would have that result for a real trading strategy, that would be my parameter of choice for going live with that strategy. Is there just out of the head a good number of how many iteration steps you should do? No. It simply depends on the range of your parameter space. It depends on your step size within that parameter space. For example, if you think you investigate stop loss between 0.1% and 3%, okay, the range is about in total 3%. But if your step size, or if you do, for example, 100,000 steps between 0 and 3%, you should need a lot of neighbors. If you have only 10 steps between 0 and 3% for your stop loss, then of course you can't take 10 neighbors. So it depends on the range, the overall range, and it depends on your step size. So there's no rule of thumb that I say, hey, you should go for 9 neighbors and so on. The same can be done in a 2-dimensional or in a 3-dimensional parameter space. There's no limitation. You do exactly, mathematically, you do exactly the same like here, but I cannot show it on a piece of paper or in a 2-dimensional Excel sheet. So, but in principle, and that is the way I do it, you can do it for more than 1 dimension exactly the same. You simply go for the other neighbors in the next dimension and do that averaging like here with those other numbers as well. And that's the way how I do that kind of optimization. Let's go back to the strategy itself. So the strategy itself was our DAX strategy, and what we did there, we applied a very easy concept. And that easy concept means we use an EMA as an indicator being long or short. Close prices above means long, below means short. And what we did first was we did everything without stop loss, then we included a stop loss as well. And what we did else has been that we apply for our stop loss calculation the ATR, the average true range, as an indicator of the volatility of the market. What we have now is we have two Excel sheets with three open parameters, and the three open parameters are EMA period, then the risk reward ratio for the take profit, and then two sub-strategies, one dealing with a stop loss in percent of our trade or of the value we trade, and sub-strategy 2 is then just an ATR multiplier for our stop loss setting. Even for C2, we use the same rules for take profit. That is simply once again a multiplier on our stop loss distance, so to say. So the final goal now is, within that three-dimensional space, we should try to find the best numbers for those parameters, taking into account that neighborhood analysis. Let's first have a look to, for example, the Excel sheet. You might remember that it looks like this. You can put numbers here for example, for the EMA. You could have a number. You could have a number once for the EMA value, for the stop loss value, and finally for the take profit value. And in order to have that Excel sheet already a little bit more like I mentioned in my slide, I don't want to have the take profit in percent. I want to have it as a multiplier of my stop loss. So the risk reward ratio, and in this case it should be a 3. And so that we do here the calculation like this. I do that kind of adjustment to the Excel sheet simply because I do the optimization with those three numbers: EML value, stop loss in percent, and risk reward ratio. Of course, I can do it here in the Excel sheet, but you see already when I change one number, I have to wait for the result. Okay, you might use original Microsoft Excel, then it will be a little bit faster, of course, but you see you have to wait because of those long calculations. By the way, one guy of you mentioned he uses the so-called solver for that process. That is an optimization tool built into Excel and LibreOffice. Of course, you can use something like that as well, but still you have limitations in speed. So in order to get now those numbers, I switch to the so-called C programs. They look like this here. That is a C program which is doing exactly the same like the Excel sheet, calculating equity curves and then calculating those key figures and so on and so on. And I will show you the results in a minute. But what goes into here, and you can see, and you can, I think, without any knowledge about C programming, you understand what that means here. I have numbers as being the search space. And for example, I use for stop loss a minimum of 0.1% and a maximum of 3%. This CR U value here is the risk-reward ratio, and I have here numbers between 0.1 and 10. And I use EMA values between 10 and 1000. So those numbers I use here, and then, as you learned already in the Excel sheet of neighborhood analysis, I have a number of steps which apply here, and that is 100. What does it mean? And that is now maybe a little bit astonishing. So I have 100 different values for stop loss, 100 different values for risk-reward ratio, and 100 different values for EMA. That means in total I will calculate 1 million different equity curves. So the task now here is find good results in those 1 million different equity curves. If you would do it in Excel, you, I think, have to wait a little bit. With that C programming, it is much faster. Let's have a look on how that works. So let's start with just the stop loss setting, and as a stop loss in percent, and I just let run the program right now. And what you will see that sometimes you get new lines here, and yeah, every line is one equity curve, but I don't print all, only if they are good enough to, let's call it good enough to be mentioned. In this case, it's a profit factor lower than 1000. Only if that condition is fulfilled, I do a printing here on the screen. And you see now already half, 500,000 of those calculations are already done. I see that whenever I go to the right, to the left here, there's sometimes a number popping up like 75 and so on. That is the outer loop, and it only takes a few additional minutes. Then we are done, and done means that we have now calculated exactly 1 million equity curves for all the combinations which are possible within those limits. So it's a huge task for calculating, and yeah, these programs are extremely fast. Therefore, I can do it even with 100 steps in a 3-dimensional space. So 1 million equity curves have been calculated. And what has been done else? We have done that kind of neighborhood analysis. Just that I don't want to go into the details of that C programming, but within those 3 loops here, we do exactly that kind of averaging, what I have showed you for the neighborhood analysis in the Excel sheet as well. In this case, I go here for 20 iteration steps. So what I do here is the same like here, but in a 3-dimensional space, and I go until the iteration of 20. Originally, the list of all the equity curves would have 1 million entries, but that list is simply too long in order to be managed, and I'm not really interested in every equity line, so I only go for the best one, so to speak, and I look now to those. And I get now those kind of numbers, and that will enable us that we find now the best values for stop loss, EMA and risk reward ratio, because now we have a list here with some parameters, the 3 parameters describing our strategy, then the sum in R, the profitability, so to say, the number of trades, the maximum drawdown, profit factor, this R2, opti, and opti-middle, that's German, so it's opti average, and this opti average is exactly the number we have calculated in the Excel sheet in the one-dimensional space, and now this number is for that 3-dimensional space until 20 iteration steps. Yeah, what are we looking now for? Exactly, once again, like in the equity, in the curve, not equity, in the curve for my fictive strategy. Now this is here that we sort that list, and now we have the best one in the first row. So that is the global minimum in the average space, and that is the numbers we should go for. So we have an EMA value of nearly 300, 296, 0.8% stop loss, and risk reward ratio of 7.4. Let me try to remember those numbers, or I copy them. So now what we can do is we can take those numbers and we can enter those numbers here. 296, and now you see the difference between calculating one equity curve and calculating 1 million equity curves. So that is the value for stop loss. I have to wait a little bit. And finally, the value for risk reward ratio. And as you see already, I don't put in all digits here for the numbers, because I know that if I go now to the right or to the left, it will not change that much my equity line. So that is the final result for a strategy based on a percentage value for stop loss. And of course, it's not the overall best strategy in terms of we can find better values for those 3 numbers and get a better result for our equity curve. But now I know that within the limit of 20 iterations, or within the limit of lots of neighbors to my my original values, that the strategy will not drop dramatically, and that is exactly what I want to have. So final result for a Dax strategy based on an EMA, the EMA value is 296, stop loss in percent is 0.85, and risk reward ratio is 7.4, or you can have 1 digit more if you want. So it's not it's not that bad if you look to the line. Of course, unfortunately, exactly in the near past, the strategy suffers a drawdown, but we have similar drawdowns in the past as well. So, of course, this will happen from time to time. We have observed those kind of behaviors in the past. We will observe them in the future. Still, what I cannot give you is any guarantee that it really works in future, but that is something nobody can do for any trading strategy, and yeah, that is nobody can do. So that is the one step for having a strategy based on a percentage value for stop loss. We can do the same for the ATR modification, and we will do it once again. Similar behavior. Once again, we have to calculate 1 million different equity lines, and now computer is up and running and doing that. And let's have a look to the parameter range I use here. So now we have those values being the parameter range. And in this case, once again, I have EMA periods between 10 and 1000. I have risk reward ratios between 0.1 and 10. And as the ATR multiplier, I use values between more or less 0 and 3. I have to mention one other number because, and that number I have not changed here, that I use an ATR period of 24. Like we did here, not in this Excel sheet, the same values we use in our Excel sheet. So ATR based on a period of 24, and I have used the same number here within this C code. Optimization process is done, is ready, so we can have a look to the final results once again. Procedure is exactly the same. That means we have a list, our candidates. Here we can sort that list to what we want, and we want to have a minimum in opti average, including all the neighbors. And now we have a second strategy, now based on an ATR value and an ATR multiplier for our stop loss setting. Let's have a look to that equity line, because this is totally different to the other strategy in our Excel sheet. So that is only as a reminder. And I have to do here the same with reward ratio. I want to have that number here. I can put already the 5.59 here. And let's have it a little bit bigger. So, and we have to adjust the calculation. And then we can use those values we have calculated. So we need an EMA of 208 and a stop loss multiplier for the ATR of 2.39. And then we are done. So we have a second alternative for our strategy, and looking to that equity line, it looks a little bit similar to the other one. Once again, unfortunately, we have that drawdown exactly right now. We have much less trades. Here we have 216. In the other case, we have had a little bit more than 1,000. But nevertheless, what we know, both parameter sets have been calculated, including a huge amount of neighbors. So at least I know for the past, the strategy is robust or stable. I can only hope that it's the same applies for the future. I cannot be sure, but I have good indications from the past. One remark to that drawdown exactly to in the near past. It's quite easy. Everybody who looks to the Dax for the last 1 or 2 years knows that there is no real trend behavior within the Dax. You can see it here. The blue line is the Dax itself. So we have a more or less oscillating process here. And yeah, that is for a trend following system. That kind of behavior is always difficult, of course, and when the next trend starts, then the profitability will come. To deal with exactly those kind of, let's call them, formations is extremely difficult for any trend following system. But what we did is we have calculated now 2 strategies, 2 sets of parameters to describe that strategy exactly for a history of more than 20 years, because we start with data from 1990. So we have a long history, which is good. On the other hand, of course, we don't know. You might say, hey, market changes and so on, but at least that is the best we can do looking to the history right now. We will learn other techniques to avoid a few things, and that is called dynamic strategy, which is always self-adjusting. That will be an additional topic for one of those next webinars, because that is a technique that has 2 advantages. One is it always adjusts to the near future, not future, sorry, that would be nice, to the near past, and it gives you the opportunity to have a back test in a more realistic scenario, because you can do those kind of experiments like adjusting to the near past already in the past. But that is a topic of one of the following webinars. Maybe so you know now the numbers, and if you can't recall them, I will send around or I will share with you the recordings of that webinars, but you still see one line here for ATR constellation, and the other line is here in yellow. That is for the stop loss in percentage. So we have 2 sets of parameters, and maybe you find it interesting to have those tools available, like C programming. Just from my end, a short advertisement here. I think that's okay. On the Tradimo website, I mentioned that already, a very good website to find everything around learning about trading. So that's a quite interesting website, and there you can find a course for C programming as well. Unfortunately, I have to mention, up to now this is only in German, but I want to mention it here already. So there's a course exactly to learn that C programming, and by the way, the final result of part 1 is more or less exactly the strategy we have done here, but that is then only an example. The main purpose of the part 1 is that you really learn C programming. It's not that difficult, and by the way, if you look here for the number of lines of code, it's not that huge. It's only a little bit more than 500 lines, and there are a lot of empty one as well. So it's not that huge effort to build up such a program. And then you have that speed, like I showed you here, that you can calculate 1 million equity curves in about 1 minute, which is extremely fast, I think. So let me look. where we are. So first strategy is done, and that already within the first webinars. And next strategies will come within the next webinars, and I hope you will join us further. If you have any questions afterwards, you want to know or just want to contact me, discuss with me your own strategies, just send me an email to, my last name is really complicated, friedrichowski@argusfx.com. And if you have any questions all around Argus, you can go to the website of Argus, of course. So that's for today. Oh, I see, even 5 minutes before the normal 1 hour, but maybe I talked a little bit faster than previous webinars. So let's see. I hope you enjoyed it, and you join the next one next week, same time, 11 o'clock in English, and at 7 o'clock you have the same content in German as well, 7 p.m. Okay, that's for now. Thank you very much for your attention, and see you next week. Bye-bye.